Okay, hi everyone, I'm James Hart and welcome to this Orbex trader education session where we're going to be talking about candlestick reading. Now, for those of you just starting to learn about Forex trading, the term candlesticks might seem a little confusing, but don't worry because over the course of this session I'm going to explain exactly what candlesticks are, their importance in reading the charts, and best of all, how you can use them to successfully trade the markets. So let's jump in straight away. And as ever, if you have any questions during the session, please just write them in the chat function and I'll stop as we go along to answer them. And then I'll also allow some time at the end for any questions that you might have. So what are candlesticks then? So when we're talking about candlesticks in terms of trading, we're talking about a visual representation of price and time data. So they're called candlesticks because simply the body and wick of the candles look like candles, okay? So you might be wondering where the term candlesticks come from, and I won't bore you with a long history lesson, but I will just give you a little bit of background so it all makes sense. Essentially, the method of using candlesticks was developed in the 1600s in Japan by rice traders who used these pictorial descriptions to keep track of price movements. So you'll often hear or read of candlesticks being referred to as Japanese candlesticks. So let's take a look at the actual candles themselves. Okay, so you can see here then we have two basic examples of candlesticks. So we have a green bullish candle and we have a red bearish candle. So I'm just going to walk you through what these different visual representations tell us about how price was moving over the session. So with each candle then, there are four main points to note, four main price reference points. We have the candle high, the close, the open, and the low. So with a green bullish candle then, what the candle essentially is telling us, price opened at this point here, at the low of the body. So the body is always the shaded area. So price opened at the low of the body. It went down as far as this point here, the bottom of the wick, which is the low of the candle, before reversing and trading all the way up to this point here, which is the high of the candle. And then from here, sellers stepped in to drive price back down. And you can see that price closed here at the close of the candle. Okay, so just to sum that up, with a green bullish candle then, the open is the bottom of the shaded part, the close is the top of the shaded part, and then the high and the low are simply the high and lowest points of the wick. So that's what this green candle is telling us about how price moved over the course of that session. So if this was a daily candle, this would be how price moved over the course of that day. If this was a 60-minute candle, it would be how price moved over that hour. So looking next at the red bearish candle then. So again, four main price reference points to note, simply the candle high, the open, the close, and the low. So with the bearish candle then, it's simply the reverse. So we know that price opened at this point here at the top of the shaded part of the candle, which we call the body. Price traded up as high as this point here, where we got to the high of the wick. Sellers then stepped in and drove price all the way back down. We traded all the way down to this point here, the low of the candle, the low of the wick, before buyers stepped in again and drove price back up a little bit, and we closed at this point here. Okay, so we closed at the low end of the shaded part of the body. So it's very, very simple, okay? The green candles, price closes above the open. Red candles, price closes below the open. And as I say, regardless of which time frame you're on, so if you're looking at daily candles, hourly candles, it's all exactly the same. So these candles are simply telling you how price moved over the course of that session. Now, these are two very basic looking candles that we're just using to demonstrate the different reference points you need to be aware of and how to interpret what the reference points are telling you about how price moved. However, it's really important to acknowledge the fact that these candles come in all shapes and sizes on the charts and tell us different things about price and how it moved. And the great thing is that over the years, technical traders have worked out that certain shaped candlesticks can give very clear indications about what price is likely to do. So now you know what candlesticks look like in a basic form and why they're important. Now we're going to walk through some of the key candlestick formations that you can learn, and I'll explain what it is they tell us about price and how you can use them to trade the markets. So Some candlestick formations are simply based on the shape of one candlestick alone and interpreting how price moved over the course of one session. And then other formations are based on the shapes of two or more candlesticks in a row and what their shapes in relation to each other tell us about price and what they suggest about the likely course of future price movement. So we'll kick off then by looking at some of the classic one candle formations. And the first candle we're going to look at is a classic, and it's one of my favorite candles. It's the pin bar candle you can see here. And it's an abbreviation of the term Pinocchio, referring to the classic European children's story. And as you can see, this candle is poking a long nose out. So we have a very small body and then a long nose. And for those of you familiar with Pinocchio, you'll know that this is a reference to the fact that every time the wooden boy's nose grew longer, every time he was telling a lie. So essentially what this means is that whenever we see these long tails on a body, it's an indication that that price is likely to reverse, okay? So whenever we see these candles with small bodies and long tails, it's an indication that price is likely to reverse. So let me walk you through what's happening with the candle and explain that in a little bit more detail. So starting with the bearish candle then. Essentially what this candle is demonstrating is a sharp bearish reversal in sentiment. So price opened here, okay? Remember this is a bearish candle, so price closes below the open. So price opened here, buyers were in control initially. They drove price all the way up to this high point here before sellers stepped in and drove price all the way down. We traded all the way down to this low point here before buyers stepped back in and drove price up a bit, and then we closed at this point here. So essentially what we're seeing is a sharp reversal in sentiment telling us that sellers have overwhelmed buyers and driven price lower. And this gives us an indication that price is likely to reverse over the course of coming sessions. If we then look at this candle here, it's exactly the same dynamic, but simply in reverse. So this time we started out at this point here. So buyers were in control initially. Sellers were in control initially, drove price all the way down to this point here, to the low of this wick, before buyers stepped back in and drove price all the way up. We traded all the way up past the open, traded all the way up to this high point here, before sellers were able to just make some minor correction and take price lower, and then we closed at this point here. So what this candle is telling us is that sellers were in control initially, driving price down, but then buyers stepped back in to drive price all the way back up. So these very small bodies closing in the lower or upper third of the actual candle and these long tails gives us a suggestion that the market is likely to reverse. And this candlestick can be a fantastic reversal signal, especially if it occurs in certain locations. So for a bearish pin bar then, suggesting a reversal lower, ideally, we want to see the candle form at a resistance level. So in this example, you can see that we had clear resistance with these prior lows which were broken. So price traded all the way back up to retest those broken lows and then formed a bearish pin bar. So this is a good signal that price has been rejected, okay? So what we're looking for is a candle to form at a clear structural level. So let's take a look at an example then and I'll explain this. Okay, so here we go. You can see here we have our textbook pin bar candle. So this red bearish candle here, you can see buyers were in control initially, drove price up to this high point here before sellers stepped in and drove price all the way lower. And you can see we closed down here in the lower third of the candle with this really nice long tail. So looking at the chart then, we see this candle, we know we've got a really solid bearish reversal candle in play. And then what you'll also notice is the location at which this candle has formed. So price has traded all the way up to test this former high, and we've put in this big bearish candle. So this is suggesting to us that we've got a likely double top formation in play, which is a classic bearish reversal pattern that hopefully some of you will be aware of. So then what we've established here is confluence between these two technical elements. So we've identified a bearish reversal candle, and we've identified it in the location of a potential double top pattern, which we know is a bearish reversal pattern. So with these two elements lining up in place telling us that price is likely to reverse lower, we can go ahead and enter a short position as price breaks down below the low of that pin bar candle. So what I mean by this is, instead of simply entering short as price closes at the pin bar, we wait and put our orders below the low of the pin bar candle. Now, the reason why I do this is it's simply a slightly more conservative way to trade by waiting for a little bit of extra confirmation. So essentially, what's happening is we're waiting for price to break to the downside to trade down below that candle low. Okay, so we're waiting for price to reverse and trade down below the low of that candle, and then we're entering short there. And then this confirms or gives us a better indication that price is likely to continue to trade to the downside. Okay, so we enter low on the break of the pin bar candle low, and then our stop can go simply above the pin bar candle high. And then, as ever, we're simply looking to bank a minimum of 2 times our risk, or we can look to trail our stop as price moves down. So hopefully what you can see by this is a really simple process that you can follow for using candlesticks and integrating them with other technical elements. So all we've done here is identify the presence of a bearish pin bar and also identify confluence with another technical element, the double top formation. Okay, so the next pattern we can look at then, the next candlestick rather, is the Doji candle. So you might have heard of this, but you're not really sure what it means. Essentially, Doji is named after the Japanese word for fool or blunder, and it really highlights what this candlestick is trying to tell you. So the first thing is, this candle is particularly easy to spot. Okay, the majority of candles will have a shaded body, but then every once in a while, you'll see a candle that comes up a little bit like this, looking a little bit like a cross with a flat body and a tail either side. So a Doji candle essentially is a representation of indecision in the market. It shows that there are an equal number of buyers and sellers over the course of the time frame represented by the candlestick. So the Doji is a fairly common occurrence in a non-trending market. However, when we see a Doji candle occurring in a trending market, this can be a sign that a market is about to correct or reverse, and this can be a really good early indication that a move is about to fail. So let's take a look at an example then, and I'll walk you through this. Okay, so if we look at this chart here then, you can see if you look at this point, we've got this really strong bearish decline in the market. So we've got price selling off in a rather orderly fashion, a sustained fashion, moving to the downside with a lot of large bearish candles. We get all the way down to this point here, however, and notice that we get our first Doji candle form. Okay, so up until this point, the majority of the candles have all had bodies, and we've seen a lot of large extended bearish candles, price trading all the way down to this point here before we see that Doji candle form. So once we see that Doji candle form, we know that this represents indecision in the market and a loss of bearish momentum, and this highlights us to the potential of price reversing to the upside, which you can see is exactly what happens shortly after that candle forms. So we have this really long sustained bearish decline. We get all the way down to this point here. Price forms the Doji candle, and then shortly afterwards, you can see that price reverses and trades to the top side. Now, if you continue to track what happens with price, then you'll see that once we've made this correction higher, we enjoy quite a sustained rally to the top side. And again, just as we saw with that decline, we're getting a series of sustained bullish candles this time. We trade all the way up to this high point here, and then once again, notice what happens. This time, we get a pair of Doji candles form. Okay, so again, as I say, these are very easy to spot in the context of typical price action, because we're getting a lot of large extended candles with full bodies, and so it's really easy to pick these candles which have flat bodies and tails either side. So we see these two Doji candlesticks form. We know that they represent indecision in the market, and this suggests that there's been a loss of bullish momentum. And so once again, we're on the lookout now for reversal. And then shortly after those candles form, you can see the price fails and we start to sell off. So hopefully you can see just how useful these particular candles can be in highlighting fading momentum in the market. And the great thing is you can either use them as signals themselves, looking to trade on the presence of the candle, or you can simply use them as an early indicator in that the market is due a shift, and then look to use other elements to gain entry into the market, or simply wait for the presence of other candles, okay, of other candlestick formations. So speaking of other candlestick formations then, let's take things up a little bit now, and we'll look at some of the two candlestick formations that we use. So these are slightly more advanced. So it's where we're looking at the relationship between two candlesticks which are side to side. But again, it's all very straightforward. I'll explain it to you now. So let's take a look at the first one. And this is the engulfing candle, or the outside candle. And again, some of you might be familiar with these, but don't worry if you're not. This is all very straightforward stuff, and we're going to walk through it now. So the engulfing candle then consists of two candles. Looking at the bullish one first, we get an initial small, narrow-ranged candle, followed by a large bullish candle, which engulfs the range of the previous candle. Okay, and so what this is telling us is that, like with the pin bar, there has been a really sharp reversal in sentiment in the market. So where sellers were in control initially, and we got this really small candle, this small bearish candle, showing that bearish momentum is waning. The large bullish engulfing candle shows us that there's been an extremely acute shift in sentiment in the market, and buyers are now firmly in control. And then again, if we look at the bearish version, it's simply the other way around. So to begin with, we get a really small, narrow-ranged bullish candle, and this shows us that bullish momentum has faded. So we've got this really small bullish candle, and then that candle is completely engulfed by the bearish outside candle that forms next to it. Okay, so it's just the opposite of what we saw with the bullish. So this shows us that sellers have completely overwhelmed buyers, and that there's been a really strong shift in the market, and this alerts us to the likelihood of further downside subsequently. So again, these candlesticks are showing reversal points in the market, and they're giving us an indication of what is likely to happen next. So whenever we spot these candles in the market, we can use them as a basic form of analysis, giving us an indication of the direction in which we should be looking to trade. But we can also look to use them as trading signals themselves, entering on the candle close. Okay, so let's take a look at an example then of this, and I'll talk you through how it plays out on the charts. Okay, so here we have a really fantastic example here. So you can see that price was in this really nice extended downtrend. We're exhibiting that typical zigzag staircase fashion that we like to see in trending markets. So price is making lower lows, lower highs, lower lows, lower highs. We trade all the way down to this point here, and then notice what happens. You can see that we put in this small bearish candle as price makes the next new low. However, the next candle, you can see that we get this really large bullish engulfing candle form, which completely reverses and closes and engulfs the whole of the prior day's range. So when we see this candle fall, we know that sellers have been completely overwhelmed by buyers, and that downside has been completely rejected. And so once we see that in the market, we then know that we have an opportunity to look to buy. Now, again, when we're using candlesticks, we've said already that the key thing is looking for location and confluence, okay? So these are the elements that we always want to be looking for. So with the pin bar, we saw how you can combine candlestick reading with basic chart patterns to identify trading opportunities. And another great way to trade is to combine candlestick reading with technical indicators to identify confluence. So this time, if we look at the same chart, but this time with the RSI indicator on, so you can see in the bottom of the panel, this is the relative strength index indicator. So basically, this indicator is measuring the strength of price moves in the market. So it's telling us whether price is overbought or whether it's oversold, and whether or not price is likely to continue in the direction in which it is going. So it's a momentum indicator which helps us understand the strength of price moves in the market. So if we're looking at this chart, then you'll notice something interesting. So as price is continuing to move lower initially, you can see that the indicator is confirming these moves in price by continuing to put in new lows. Okay? So as price is moving lower, the indicator is telling us that bearish momentum is increasing as the indicator is continuing to put in new lows. However, from this point here, you can see something interesting happening. Although price is continuing to put in new lows, the indicator itself is starting to put in higher lows. So when we see this dynamic occurring, when we see the indicator starting to print higher lows, despite price continuing to print lower lows, what we have in play here is what we call bullish divergence. So this tells us that bearish momentum is waning and that bullish momentum is starting to build. Okay? So bearish momentum is waning, although price is moving lower. And so when we see this happening, this puts us on alert for a reversal. So this is bullish divergence. We're on the lookout for a buying opportunity because we're looking for bullish reversals. If we were identifying bearish divergence on the indicator, we'd be looking for selling opportunities. So price is moving lower. The indicator is telling us that we've got bullish divergence and we should be on the lookout for a reversal higher. And then as we get down to this point here, you can see that we get our big bullish engulfing candle. And so we can go ahead and use this candle as our entry point to the market. So essentially what I'm showing you here is the process by which we can combine these candlesticks with basic technical indicator reading to create a two-tiered approach to trading the market. So we're using the indicator to give us a heads up as to in which direction we should be looking to trade. So in this instance, the market is selling off, we're moving in a bearish trend, but the indicator highlights bullish divergence, telling us we should be on the lookout for a bullish reversal. And then at this point here, you can see we get our big bullish engulfing candle. And so we get our bullish reversal signal, and so we get our opportunity to buy. So this is a really simple and straightforward way to combine candlesticks with indicators. And the great thing is it's extremely versatile. You can use it on all time frames, and you can really use candlesticks with all indicators as well. So this is just an example with the RSI, but you can use it with moving averages on the MACD or Bollinger Bands, or whichever other indicators you like to use. Okay, so let's move on then now and take a look at our final candlestick pattern, which is called the Harami candle or the inside bar. So this is simply the reverse of what we saw with the engulfing candle. So this time, instead of the larger candle forming on the outside and engulfing the prior session's move, this time the larger candle forms as the first candle and the smaller candle forms on the next day, forms within the range of the first candle. So I'll walk you through then. What we're seeing here with the bullish example is that to begin with, we have a really large bullish day. So we've got a strong buying momentum. We get this large bullish candle, we close here, and then the next day, you can see we get a contraction in momentum. So instead of price continuing upwards in the bullish direction, we've actually put in a small bearish reversal, and you can note that the candle forms completely within the range of that initial day. So what this is telling us is that momentum and volatility have gone from the market and we've seen a pause in the move. So you'll often find these patterns occur following extended moves where the market has simply moved far too fast. The market's cleared too many orders, reducing the liquidity needed for the move to continue. So the market needs to consolidate to allow more order flow to go through before the move continues. And the exact same is true with the bullish pattern, okay? So this time we're simply seeing an instance where price has sold off strongly, we've made a strong bearish move, we've got this large bearish candle, and then on the next day, or the next session, whichever time frame you're looking at, you can see we form this really small bullish candle, again, completely within the range of that initial day. So once again, what these candles are simply telling us is that we've had a contraction of momentum in the market and a loss of volatility and a loss of directional impetus. Now, this pattern is extremely useful and effective because it can be used in different ways. It can be used as a reversal signal at resistance or support levels, and it can also be used to highlight breakout opportunities in trending markets. So, looking at this example then, let's take a walk through this. So looking at this example, you can see here an example of how we can use this as a reversal candle. So you can see that price put in this big and low initially. So we've had quite choppy range-bound markets. We made a big darting move to the downside here. Price put in this big low. We hit a big support level, bounced, traded all the way back up to this point here, before then reversing and trading all the way down to this low point. So notice what happens when we trade down to test this low point. And again, as we saw with the pin bar forming a double top, what we're actually seeing here is price testing a big structural low, and so essentially forming a double bottom, okay? So price is testing this big prior low. You can see we traded into the level, we've pierced it slightly but failed to break it, and then the next candle, you can see, forms as an inside candle. So the first candle is that large bearish candle, and the second one is this smaller bullish candle which forms completely within the range of that first candle. So this tells us that there's been a distinct lack of momentum in the market. So momentum has been lost. volatility has contracted, and we've seen a small reversal in sentiment. So what we can do then is go ahead and place a trade as price breaks above the top of the inside candle low, with our stop below the low of the inside candle. And again, what we're doing here is combining these basic candlesticks with some very, very basic market savvy. So we're looking at basic chart patterns here. We've got a key structural support level. We've got a potential double bottom in play. We've got our inside bar telling us that there's been a loss of momentum in the market, signaling a potential reversal. And then we're taking a very basic trade, playing the break of the top of that candle with a stop below the low. And again, our aim is to always bank at least 2 times as much as we risk. So this is a really great way of highlighting potential reversal trades as the market trades into some of these key structural levels. And again, what we've highlighted here is a support level, but you could equally do the same as price tests a moving average or tests a key Fibonacci level, or indeed tests a trend line. So the basic premise here is that you're identifying these candlesticks at key locations. So let's take a look then at how you can use this candlestick also to enter into trending markets, because this pattern can also prove particularly effective at highlighting breakout trading opportunities. So we know that the market moves in a pattern of trend and range, expansion and contraction, and the formation of this candle pattern can be a really great signal of a potential expansion coming once again. Okay, so if we look at what's happening on this chart here, we can see something really interesting. So we've got our key resistance level in play. So price rallies all the way up, we get this really strong move to the top side. We hit our resistance level here and stall, trade back down. We trade back up towards that level, and again, sellers step in early, drive price back down. We then trade higher, trade all the way back up, test that level, and then for a third time, sellers are stepping in and driving price back down. However, you'll notice at this point here that buyers actually outstrip selling pressure in the market. So we've got more demand in the market than there is supply at this point. Buyers push through, price trades all the way up to this high point here. We close with this really large bullish candle signaling the extension. And then notice what happens. So we get a further bullish candle here, but then at this point here, we get this little bearish candle that forms inside that bullish candle. So this time we aren't looking at this candle as being a reversal, because we're not in any location for a reversal to occur. Indeed, we've broken through this key resistance level and we're looking at a market breakout. And so this time we view this candle as an opportunity to get in as the bullish breakout continues. Okay, so we've had our big expansion in the market. We know that when we get these big breakout moves, the market tends to chop because we clear too many orders too quickly, liquidity gets reduced, and so the market pauses to take a breath. We get this inside candle form, and then this gives us an opportunity to get in as the market reloads, almost like a slingshot being pulled back before it releases and continues. Okay, so this is the complete opposite to what we were just looking at. So instead of trading this candle as a reversal, this time we're trading this candle as a continuation pattern. So we've had our expansion in momentum and volatility. We've had a pause, a contraction in momentum, and now we're entering as price breaks out above that candle high, anticipating a continuation of the move. So this is a really fantastic way to enter the market in a big breakout move, which for a lot of traders can often be a very tricky way to play the market, or a tricky location, because a lot of people end up simply chasing these candles blindly. And as we say, once a big breakout move occurs, liquidity starts to get reduced and you can often get very volatile, erratic price movements. So you need to have a really solid, well-defined way of entering the market to benefit from this momentum. And this is definitely one of the ways you can look to do it. Waiting for the breakout to occur, then waiting for that pause as signified by the inside candle setup, and then getting in as the inside candle breaks in the direction of that initial breakout. Okay, so I hope you all enjoyed that session and found it useful. Although we've only looked at a few of the basic candlestick formations there, hopefully by now you have a much better understanding of how you can use candlesticks to read the market and make trading decisions, and also have a few basic setups that you can go away and work on. Now, as with all trading strategies and methods, the key to success lies in proper risk management. So make sure that you're always using a stop when you trade, Make sure that you keep your risk conservative and look to risk no more than 1% per trade, and always be aiming to make positive risk reward on your trades. So this means only looking to take trades where you stand to make more than you risk losing. And doing this will give you a much better chance at being successful in the long run. Okay, so just before we wrap up, are there any questions I can answer for anyone now? Brilliant. Okay, well, I'm glad that you all followed along with that and enjoyed the session and found it useful. Thanks a lot, and I look forward to catching up with you all next time. In the meantime, take care and enjoy your trading.